Hi, in this video we're going to talk about how to achieve actually these kind of performances over here. And how can we achieve this using nothing but just Bitcoin. So the strategy we are going to talk about here is just looking at Bitcoin's price once per week. So we don't have to actively trade in and out. We don't have to always look at the price. All we need to do is we go, say, Monday morning to our computer. We check a certain condition where Bitcoin's price is. And based on that mechanical condition, right? Based on this rule, we then decide, do we want to be invested in Bitcoin or do we want to rather be just in cash? Right, so sometimes we are just in cash. So when we look at this very closely, that was not intended. Let's go back. When we look at this very closely, we see sometimes we are just completely in a sideways movement, right? This is just when we are in cash. And sometimes we do follow Bitcoin's price movements. And the compounding effect of all of this, right? When you are constantly better than just buying and holding, that then leads to this vast outperformance. So in blue over here, we've got Bitcoin. Again, I'm just toggling here. Gotta figure that out. So in blue, we see Bitcoin's price. And in orange, we see the outperformance. Now, the problem here with this chart, right, why it doesn't tell us too much is this chart only shows the performance on a linear scale. So from 10,000, 20,000, 30,000, etc. So we don't really know what was going on here in the early days. But we do want to know, right? Did this strategy also outperform in the early days? And the answer to this is yes. Now here's a slightly different color coding, but bear with me. So in blue, again, we've got the Bitcoin price. So that's the same as in the previous chart. But this time our portfolio line, the line that represents the performance of the trading strategy, that's now here in gray. Okay, so we see that the gray line pretty much all the time is above the blue line. So we are constantly outperforming. This seems to be working relatively consistently. Now, what is this new orange line over here? Now, that's a moving average. You've seen this pretty much in any kind of YouTube tutorial, probably, any kind of YouTube video on crypto, but which does some kind of technical analysis. That's a moving average. There's no real magic here, right? But where the magic comes in here, how this kind of a return could be achieved theoretically, right? If all the structures, all the market dynamics stay the same, how this outperformance can be achieved is by finding out what duration of that moving average works the best. So let's switch to another chart here, right? So this is now, again, Bitcoin on a weekly chart, but this time in trading view. And let's only look at one. Yeah, let's look just at one of those moving averages. And so in here, we've got Bitcoin, we've got the moving average. We can change a few parameters over here. We can manipulate this to a certain degree. And so here we've got a parameter called length. So this now sets how long should our moving average be. In this case, how long should our weekly moving average be? How many weeks should be included in that moving average? And so when we take a very short duration, this looks very, very different to when we take a very long duration, right? There's kind of different implications here. And so let's discuss what kind of trading strategy one might build with those moving averages. The most straightforward one, and that's the one that's backtested in this video, the most straightforward strategy is to simply buy whenever the price is above the moving average and to sell whenever it's below, okay? So let's say we would buy over here. The week closed above the moving average. So in this case, that's here, actually. It's not over here. Here we are slightly below, and then the cursor jumps. So here we are above the moving average. We close the week above the moving average. This is where we would be buying. And here is a problem with the camera. Okay, happens. So there we go. So we would be in the market. We would stay in the market for all of this time because the price is above the moving average. And then we would be selling, right? Where would we sell? We would not sell within the week, right? So even if we kind of like go in and out of we cross this moving average within the week, we wouldn't be selling here according to that strategy. We would only look at the end of the week. So in the end, we would be selling here on the 17th of May. So the trade, the positive trade in this example would be from this point to this point, okay? 293%, probably pretty much the best trade. Actually not the best trade, but one of the best trades in this entire data set if we take this random moving average, which is here the 30 week. Okay, so that's the idea. We would buy whenever the price gets above, we would sell whenever it's below, we would stay outside as long as we are below this moving average. And then the question is simply, how long should the duration of that moving average be? Right? That's the holy grail question. That's what worked best in the past. And then, of course, we don't know for certain that this will continue to work in the future. But at least if we want to use moving averages in this way to trade in and out of the market, then this is probably our best bet, right? Whatever worked best in the past has probably the best shot and also working in the future. And so let's go back to the backtest. Let's go back to this controlled simulation of buying and selling. Okay, so what we're doing now is we look at all of Bitcoin's price data, like all these 10 years, more than 10 years, and we just simulate. We simulate with the computer buying and selling, and we simulate a portfolio. We simulate this strategy, the return of that strategy, and we just go through this with all of those different moving average durations. And so what do we get? Let's look at this. That's the main first result of this whole analysis. And this is now where our first very valuable point here comes in. But before we go into this, right, before I explain this is pretty complex. If you could do me a favor, in case you haven't yet, if you would subscribe, that would, of course, be very much appreciated because this channel is still very, very small. And so, of course, every single subscriber would help. So feel free, if you so far feel this content is valuable, of course, don't forget to subscribe, right? So, okay, so this little ad out of the way, let's go with the result. So what we see here are different backtest results. So at the x-axis here at the bottom, we see different durations of the moving average. So what I have backtested are the moving averages from the duration of 1 week. So basically just looking at the last week's price, did it go up or down, all the way to the 52-week moving average. So I've backtested trading according to those moving averages durations. And so when we just look at this, right, I simply just went through every single one of those moving averages, right, all the way up to 52. Okay, and I've simulated buying and selling according to this line over here. And so what moving average worked the best for this trading? This one over here. This indicates the annualized performance that we would get when we trade according to the moving average. In this case, the annualized performance was somewhere above 160, right? 165, something like this. We'll afterwards look at this also in table format, so there's more data to come. So that's the best, right? This here is the best moving average. We zoom in over here, we look at the duration, we see it's the 6-week moving average over here. Okay, 6-week moving average. And so what you can also see is that once we go too far out with our duration, right? Once the moving average duration is too long, then we do not really perform that well anymore. Now, what's this black line over here? It's buying and holding. Okay, so if we just bought Bitcoin and we held it over its entire history, we never sold it, then we would have gotten annualized 110% per annum. And sometimes we go in, sometimes we go out of the market, but we didn't really gain anything from that if we used any moving average that was larger than the 21 week. Okay, that's how it looks like. So there seems to be pretty much a bias towards being relatively recent. The trends, they don't seem to last that long. They last a few weeks. But once we go beyond, say, beyond half a year, for example, we're definitely already too far out. We react too slowly. Our moving average duration is too long. Okay, so that's only actually the beginning of this entire test that I've done. It becomes way more complex than this. But of course, the reason why we want to make this more complex is to find out, is there maybe a better strategy, right? We still want to keep it to the weekly data, because the idea of the strategy is to not be so active, right? To just sometimes look at the price and not always be stuck to the price, and like psychologically also, maybe sell whenever it crashes and do all kinds of bad moves. So we don't want to look at this too often. But maybe there's different moving averages that we might use. And one pretty straightforward way to do this, is using the exponential moving average. Now, what we so far looked at was the simple moving average. And what does simple mean? It means we average out the data of, in this case, the last 52 weeks. We average out all of these prices, and we take each of those prices with the same weight. Okay, so we add up all the prices in the last 52 weeks, we divide it by 52, we get the average price, and we can plot the point over here using all of that data in the last 52 weeks. And so that's why, for example, also when you scroll here to the very beginning of this chart, you will see this moving average doesn't start for the first 51 weeks, right? We don't have yet enough data to calculate that. So that's the simple moving average, just simply averaging the data out. The exponential moving average is slightly different. The exponential moving average takes more weight to just the recent data. So it assumes that there's more importance to whatever happened in the recent past, and we shouldn't really weigh the prices of 52 weeks ago to the same degree. It's probably not as useful. And so maybe we can react to the price movements a bit quicker, right? Because that's in the end the problem when we are too slow with the moving average. Let me show you. So let's say we go very short, or let's say we go here with a 30-week moving average. We can see this moving average is not reacting very quickly. This was the Corona crash. And we exited the market relatively late, right? After we have already crashed down for like 15%. But the main problem is we also entered the market very, very late. So we already went up by, 46%. So wouldn't it be better if that moving average would have a bit of a recency bias, right? And it would take these recent prices with a bit more weight, because then the moving average would go down quicker, and then we would potentially buy back in quicker, right? If you know what I mean. And so let's actually plot now the exponential moving average. So much talking about the exponential moving average, and I didn't even draw this yet. So we press /, click here on moving average exponential. We get another line, barely visible, so we have to change this styling somewhat. Let's make this red. Make this a bit more thick, a bit fat. And let's also do the same duration. Let's take 52. Okay. And so what we now see, is this the same? This is not the same duration. Okay, 50. Okay, let's take 30 for both. So that was a bit of a error. And this was another mistake. Oh, okay. So what I was plotting before, this yellow line, was already the exponential moving average. It didn't make a big difference to the argument I was making. But now that I need to show the difference, it does make a difference. So let's add the simple moving average, because the simple moving average will now show us how it's less reactive. So let's take the simple moving average and make that in red instead, with a 52-week duration. And we should see that this moving average does not react as quickly. Yes. So there we go. So the exponential moving average is in yellow. And let's quickly just double check. Okay, 30. Yeah. That's when you get a bit too fast. 30, 30. Okay. 30 exponential in yellow and 30 simple in red. There we got it. And here's now my point. Finally, we got it. The simple moving average reacts slower, right? It crosses the price here a bit slower. The exponential moving average is closer to the price. So when we also look here at this price movement over here, the yellow exponential moving average, it's closer to the price. It takes the recent data more into account. It weighs the recent data more compared to the past data, and thus it's simply more reactive, right? It's moving quicker. Here, look at this shakiness, for example, in this recent past. The simple moving average, it just smoothens everything out. It's very calm. It's just going sideways. Whereas the exponential moving average, it's way more reactive to the recent past, and it's erratically going up and down, right? It's way more reactive. Okay. So that was a lot of explanation around why one might potentially prefer the exponential moving average. And so that was all the theory. Let's actually look at the practice. Is the exponential moving average better? That was the result. So the answer is no, right? The exponential moving average for pretty much every data point, almost, is worse than the simple moving average. The green line is basically everywhere above the red line, especially for the longer durations, but also for the very profitable shorter durations. The overall shape of the curve is the same though, right? So we see just looking at the last week doesn't make much sense. Looking at comparatively short time frames does make sense. And once we cross a certain threshold around a 20-week mark, then we are going to not outperform buying and holding. With the exponential moving average, we are even underperforming pretty clearly, which kind of makes sense when you don't have good signals. Because think about this, right? Actually, if we do perform equally well to buying and holding, say for the 48-week simple moving average, right here, that data point over here. Or let's be more precise. Let's take here the 44-week, okay? The 44-week, it pretty much performs the same as buying and holding. But I'd still actually prefer that simple moving average result compared to buying and holding. And why? It's because of risk mitigation. Here, look at this. This is an example backtest with a longer duration moving average strategy. And what we see over here is that the end performance, it is very similar to buying and holding. It's slightly below, okay? But the end performance is very similar. But the way how this performance was generated, I think is better. Why? Because we don't face that many drawdowns. So say you would be, let's say you do not like your crypto portfolio to go down by like 90%, okay? Let's say just this simple thing. This drop over here, for example, right? This was the Mt. Gox crash, where the Mt. Gox crash, the Mt. Gox hack happened. We went down, I think, by like 80% or so. Actually, we can measure this. Why don't we measure this? Here in TradingView, here, this is the Mt. Gox hack. Let's also look at the week, at the intra-week movements. Okay, so not intraday, but within the week. If we look at the maximum drawdown here, right, for the Mt. Gox bear market, we are looking at 87%. Okay, 87%. If we just look at the weekly closes, it's still not too great, right? It's 77% or 78, right? I didn't measure this super cleanly, but you get the point, right? It's 78% pretty much. That's the kind of drawdown you face with buying and holding. And especially when you've got quite a lot of money in crypto, then this is not nice, of course. So this is kind of like a fix to this, right? We are exiting the market. We don't face as much downside. So maybe instead of 70 something percent, we would have quote unquote only lost 50%, maybe something like that. That's not great, but it's comparable to what stocks in the worst cases lose. So that's bearable. That's okay to put quite a bit of money inside. It's the same with the crypto winter over here, right? The last crypto winter 4 years ago. We didn't got spared of all of the crash, but the worst part of it, this was another 50% drawdown over here. We did get spared from that. So it's not as bad. It doesn't feel as bad. You come out with the same kind of return, but you get spared from these crazy crashes. That's why I think, even though these results here, they don't look impressive, right? I wouldn't use them for trading. But if you see somebody using this actively for trading, using, say, the 48-week simple moving average or something in that realm, it's not that bad. It's still better than buying and holding, in my opinion. So that's what I want to say. Now, here we go. So this is now the exponential moving average. So I'm not sure if I would prefer those though, right? These were pretty much constantly underperforming buying and holding. And these are pretty significant changes, right? This is compounded. This is per annum, right? So per annum, we underperformed using this strategy with the exponential moving average, in this case, by, what is it, 15%? Yeah, 15% per annum, or 16% per annum even, right? 16% every single year. Compound this over 10 years, and you see this difference matters. Okay? Now, this is not where we stop, right? This video is not short, so there is more. Of course there's more. Because when we don't solve this with one layer of complexity, maybe we can solve it with 2 layers of complexity. At least that's what I try to find out. So this is what we are testing next. Over here, we've got 2 moving averages. On the one hand, we've got a simple moving average. On the other hand, we've got an exponential moving average. And maybe we can come up with a combined approach. Because let's look at this. When we've only got one moving average, we might sometimes face bad signals, failed signals. So for example, over here, right? In this case, we would have sold on the 13th of December 2021. And then we would have seen Bitcoin rise again by 9%. We would go in the market again. We would buy 9% higher, just to then again afterwards sell on the 27th of December. So that's not a great strategy, right? Buy high, sell low. That's kind of the opposite that we want to do. So these failed signals, they are not pretty. And so the idea here is, can we somehow clean this up? Can we maybe combine 2 moving averages? The idea being that maybe when we combine 2 moving averages, we can filter out a bit of that noise and we can be more confident around a certain movement. And so if we just check all of those different durations, maybe we find one combination that works the best. So what I've tested is a combination of 2 specific moving averages. On the one hand, we've got a simple moving average. On the other hand, an exponential one. And the exponential moving average is always 1 week longer than the simple moving average. Okay, so simple, we've got, for example, 5 weeks. Exponential, we've got, for example, 6 weeks. Okay, or 10 weeks, 11 weeks, or 15 weeks, 16 weeks, or 20 weeks, 21 weeks. Okay, so that's what we look at. These are the different kinds of moving average combinations we look at. And then the strategy, of course, is also a bit more complicated. The strategy is we want to buy whenever the price crosses both moving averages. So that's the necessary conditions. Both moving averages have to be crossed. And we sell whenever both moving averages have crossed as well. Okay, so this movement over here, for example, where we crossed only one of those moving averages, we simply ignore it. We do whatever we did in the past before. So in this case here, we have been in the position, we have been long, we held Bitcoin, then we went below one of those moving averages, we didn't sell, we just waited and continued, and so then we continue going further up. So you would have had to cross both moving averages in order to sell. The same is true the other way around, right? If we are outside of the market, for example, over here, right, we crossed both moving averages, we are outside of the market. If we then only cross one of those moving averages, we are not yet buying. We are only buying once both of those moving averages have been crossed. So in other words, if the price here would have gone down again from here, so we only cross one, then the price continues to go down again, goes below this one single moving averages, we simply stay outside. So we only look at what's our current state. Are we in the market? Are we out of the market? And we would only change that state in case both moving averages get crossed. Okay, that's the strategy. Okay, so hope that was clear. Again, I've tested all of those 52 moving average durations. So we are now looking at 3 strategies with 52 weeks. So that's 152 backtests. So if so far you enjoy this kind of content and you haven't given this yet a thumbs up, then I think now would be the time, would be very much appreciated, right? It helps the YouTube algorithm, the whole channel will grow more, etc. So please give this a like. Thank you very much. There we go. This is the combined strategy. Simple moving average and exponential moving average, with the exponential moving average with a duration that's 1 week longer. The yellow line, it looks a bit messy now, okay, right? So it's all these lines. But maybe just look at 2 colors here at once. The yellow line, most of the time, is below the green line. Right? That's the result. It's not good, right? We do all this effort, we try to refine the strategy, and we try to figure something out in order to get to something that's better than a simple moving average, and we don't find it. The 6-week simple moving average works the best. So if you're wondering, what's the strategy shown in this chart over here? It's trading according to the 6-week simple moving average. That's really what you need to do. If you only want to time the market by looking at the Bitcoin price a single time per week, and you expect that Bitcoin price movements tend to behave in a similar fashion as they have done in the past, then the 6-week simple moving average, that's what the data suggests, seems to be the best. That's what this chart here implies. Now, I've got something for you prepared. Look at this. This is the whole thing in table format. Okay, so over here we've got the simple moving average, exponential moving average, the combined approach, buying and holding, and over here we've got highlights. So the best simple moving average is the 6-week, the best exponential is the 7-week, the best combined is the 12 simple plus 13 exponential. Some people also like to use the 20-week simple and 21-week exponential. This is simply a comparison chart, right, that you can see the difference in performance. Don't be fooled though, right? This looks like not so much difference, right? Like what are 20 percentage points or 21 percentage points? This is compounded over more than 10 years. So this is a massive difference. So 165% per annum versus 111% per annum compounded over more than 10 years, in the end, looks like this. It's so massive that you can barely see Bitcoin's price on this chart anymore. That's what we are looking at. Okay. Now, all of this backtesting, right, it did take a bit of time. And if in case you are interested in more, right, in case this is something that you enjoy, then you might consider looking at the premium membership, because over there I've got a video, a 45-minute video that explains in detail how I have built that backtest. So you can download the file to all of this data. So this has been done in Microsoft Excel, so no fancy software here. You can download the Microsoft Excel file, you can watch this 45-minute video, and you can then build your own backtests. Say you've got another kind of trading strategy, right? You use another indicator. Say you've got different kinds of ideas. Maybe you want to build the buffer zones differently, or maybe you want to backtest something else than Bitcoin, whatever you want to do. I think these kind of skills, they're probably valuable, right? In the end, they are valuable. So if you're interested in that, feel free to check that out. TheBitcoinStrategy.com is the link that's also in the video description. Now, there's also a Telegram channel where we are mainly discussing the current market, right? So the Telegram channel is there in the, wait, what can I see? Here, over there, right? So Bitcoin Strategy channel, you can search for that within the Telegram app. Make sure though, when you join that channel, that you don't get scammed. There are tons of people that impersonate me, that message you directly, that pretend to want the best for you. They just try to scam you. So I'm never going to message you directly one-on-one, right? These are scammers. So be very careful if you enter the Telegram group that you do not get scammed. So that's about it. I don't have anything else to say. Of course, if you've got any questions, right, feel free to comment this down below. And yeah, notification bell, subscription, all of that. Thanks for watching, and hope you enjoyed this. There is another backtest video right after this. This is for the daily prices. So that's again for Bitcoin. I personally like to use the daily prices more because I'm more of an active person in the market. So if you're interested in the daily, in the best moving average on the daily for Bitcoin, it's also a bit of a more complex analysis again. It's a segregated analysis. Then feel free to check the video out. It will pop up over here right now. Okay, see you, and see you next time. Bye-bye.